As fiduciaries of our investors' money, Futuregrowth Asset Management has been strongly committed to building a fair and transparent bond market that allows borrowers and investors to negotiate bond issuance terms on an equitable basis. Over the past few decades, institutional investors in our listed debt market have lost billions of rands in the many corporate bond defaults and restructures. These have included FirstRand, African Bank, Real People, Adcorp, Bezel Reed, PPC, and CIG. Since 2017, we have been on a long and time-consuming journey to address these shortcomings that resulted in the aforementioned credit events. We have had numerous engagements with the JSE, both orally and written, individually and as part of ASISA Fixed Income Standing Committee to ensure investor protections we believe are lacking are included in the debt listing requirements. At the end of July 2020, the JSE published the final version of the new debt listing requirements, and while there have been some wins for investors, in many respects they are still lacking or substantially weaker than loans negotiated directly with two parties. Listed bonds are still loans and should provide the investors with suitable protections against credit degradation. Land Bank's 50 billion debt default in April 2020 highlighted the practical shortcomings that still exist. It took nearly 3 weeks to collate the register of Land Bank note holders and call a meeting. Unnecessary delays like this during credit events negatively impact both the issuer and investors because decision cannot be taken quickly, potentially weakening investors' position and ultimately putting clients' money at risk. This hasn't been a once-off problem. Investors faced similar difficulties during African Bank, PPC, Umgeni, CIG, and Steinhoff credit events. Given the complexity of the Land Bank default, investors also needed a devoted investor representative to facilitate restructuring negotiations with the issuer. Investor legal representatives paid for by the defaulting issuer were also required. These are both standard lending provisions and non-listed loans, but contrary to our recommendations, remain missing in the JSE DLR. When Land Bank defaulted, investors were not paid compensatory default interest for the increased risk, another requirement that the JSE did not include in the amended DLR. The JSE also did not incorporate our recommendation for issuers to clearly define the calculation of the methodologies used for debt covenants. Covenants are useful guides to a company's performance, and if covenants are not within the agreed levels, it can give rise to disputed rights for bondholders. This was the case with one of the property issuers. Disagreements over the calculation methodology of the loan-to-value covenant resulted in a dispute with no mechanism to resolve it. As a result, investors were not able to exercise the rights that should have been available to them. To address these and other material shortcomings in the latest listing requirements, the industry body, ASISA, and asset management industry representatives, including Futuregrowth, came together in 2020 to agree to a list of ASISA-approved guidelines for listed bonds. Over the course of the next year, we all agreed on a list of additional guidelines. These ASISA-approved guidelines were unanimously adopted by the ASISA Fixed Interest Standing Committee in March 2021, and thus are supported by the overwhelming majority of institutional fixed income investors in South Africa. We, as Futuregrowth, have already embarked on an engagement strategy to ask new issuers to incorporate these guidelines into their loan documentation. We would also like to see the existing issuers implement these recommended amendments to their existing domestic medium-term note programs within a reasonable time frame. But for the guidelines to be effective across the industry, the people responsible for managing people's pension fund money, that is all institutional asset managers, would also need to get on board with these. Thus, we would urge trustees to ask their asset managers to support and implement these guidelines. Only if we all stand together in negotiating better, more equitable deals for our collective clients will we build an equitable debt capital market, one that protects both issuer and investors and provides a fair platform for buying and selling listed debt instruments. We recognize that this may take some time, but we need to start somewhere. It is up to us to do better on behalf of our investors so that history does not repeat itself.